So what you see is the stock market does pretty well. Everyone has been complaining about the deficit and for years, but a lot of people in Wall Street they say, well, being practical about it, looks like you're going up and the stocks are going up and the purchasing power doesn't really matter until you look at this chart. You never see this chart. The chart you see in Wall Street all the time is this chart. They said, this is the time in the market, not the time out of the market. Don't time it, just stay in it. And that in stocks are in fact hedge against inflation. Well, when I come over here, you will not see this chart in Wall Street. This is net of inflation. And in fact, there's times when stocks do not outperform inflation. In fact, if you own stocks here in the 29, it took 25 years for your purchasing power to get back even. If you own the stocks here in 68, it took 25 years to get back even. If you own just here recently from 2000, it took 14 years for you to get even with your purchasing power on the stocks. Now, this is the S&P 500. So now, what Wall Street has done to deal with this, I mean, you get to see this chart, but to deal with this chart, Wall Street has come up with is this chart. This is a trade-off between stocks and bonds and how they relate, these two asset classes, how they relate to one another. And the premise to this strategy came from Harry Markowitz in 1952 when he came up with all of these numbers. And by 1955, Wall Street went to their institutional investors, large pension plans in the 50s, so I'm starting around 55, 56, and told them that you can, and convince them, you can add equities and not increase your risk exposure. And they said the reason for this curvature in this efficient frontier that they call it was due to the diversification between a conservative asset and a risk-on asset. And this is a 65-year time horizon. Now, this is a 95-year time horizon. It shows you the same kind of relationship that bonds this volatility can diversify. Now, you make smaller rate of return, but you mitigate the overall risk owning equities. Now, in 81, 82, Wall Street took this concept, and dropped this concept down into where retail investors are. And to this day, this is the dominant strategy for retirement plans for the last 50 years. And so the question is this strategy that will work for someone who has an unlimited time horizon, say 65 years, does this strategy hold up? The premise to this strategy, does it hold up over shorter periods of time, say 10 years periods of time? So we went to AI and asked them this question, and this is the results that we came back with. And here we'll look at the efficient frontier going in 10-year increments. Say if you're 55 or 65 years, the next 10 years are pretty important to your retirement planning, and the premise to your strategy has to be correct. And that's what we're trying to figure out here. So as we go along here, you can see that this is still a positive slope curve, and everything is great. And this is where, like, starting at 55 up in here, you can see this fish hook effect, which got the pension plans to start investing in stocks. Before that, all they invested in was bonds. So everything's going fine until we run into the 70s. And then all of a sudden you can see here, stocks are not doing well and bonds don't help. Again, here's another, bonds aren't doing well, bonds don't help. There's no diversification there. They mitigate the overall risk, but there's no help. Here again, stocks need help. There's no help. Again, no help, no help, no help. This would even be pretty bad. And so it wasn't until going into the 80s, things straightened back out, where things got more in a normal risk profile. But all of a sudden, you have bonds that are more volatile than the stocks that they're trying to diversify. And you're not getting paid for this volatility. Now, this doesn't look like any 65-year or 95-year positive slope curve. This is completely different. This is flipped. The more bonds you have, the more volatility you're bringing on. So this happened. Then in the 90s, things straightened out a little bit. Then you come into, you come into the 2000s. And again, you get a lot of volatility in the bonds. But here, all of a sudden, for the first time in 95 years, the market needs some help and bonds help. And it did that for a couple of years. But then this thing turns into where all of a sudden you have both asset classes, very volatile. And this is like owning a hotel on the beach in Miami and to diversify by another hotel on the beach in Miami waiting for a hurricane to come through. The premise of the strategy doesn't allow for these two asset classes to act exactly the same, and that's what's going on. So we take it out over here into 25, the last 10 years, 25, and the bonds are not helping, and that's problem because there's a spending problem and inflation that's not getting any better, and that is not a positive development for bonds. So if you look at the data doesn't support that this is a valid premise to the strategy to own stocks and bonds in a static way, that they will maximize your return and minimize your risk. They will not do that. It's going to take a little more hands-on. So in our site, we're different that I don't want to own the S&P 500. The S&P 500 is made up of half successful companies and half that are not successful. So we want to build a portfolio from the bottom up, companies that are successful, which brings up the question, well, what is considered a successful company? And we go back to Ben Graham, Warren Buffett, is a company after all expenses that has residual value, what analysts call today free cash. So we make calculations in the cash flow statement, especially I want to know the core operations of a company. If it's successful, are they bringing value added to the shareholders? If they are, we consider that a conservative investment. If they're not, we consider it speculative. But the reason why I want these companies that have successful core operations from their product and services is those are the companies that will need, probably can have, and probably will need that kind of success to pass on, have some pricing power in a world of inflation that I don't see going away. So I want to own these companies that are successful enough that they can pass on price increases when they can. Now, the tools I have, we look at sectors, we have buy and sell in all the sectors, we have dividends, all our dividend stocks. It's very important our dividend stocks have a growth component to them. I don't want to own any stock, a growth stock or a dividend stock that does not have a growth component to it. So I'm not buying a stock just because of a dividend yield or not understanding that it has no chance to have any growth potential. We also can show different stocks that we like in the S&P, technology, our buy stocks, large, minimum, small. You can look at that. We have a section that's sell short. We have one of the best records, sell short for many, many years. This is a very good list. You can build a portfolio and manage your portfolio, just using our tools to review and monitor your portfolio, maybe take you 45 minutes a week to go through our research reports that identify if there's a problem or not. In this toolbox, let me get on here, the toolbox, we have a spreadsheet that you can take a look at our metrics and sort and filter the way you want. That's very handy. And so we have a term section to make sure everybody understands the terms that we're using. So, but at the end of the day, we're going to say 60% of the portfolio based on this bottom analysis, not the top down. I want a bottom up analysis. In our database, we have maybe 3,200 research reports. 750 are conservative stocks that have a very successful business. So we want to own 20 or 30 of those 750. But all of that is there. And so anyway, I hope you see this information is help you put things in perspective. And that'll be it for the day. And remember, buy the good ones. Thanks.